assessments and reassessments. We have with us, we are organizing today with our Mr. Shrita Basu, partner PwC, Mr. Deeparun Mukherjee from PwC, Mr. Kapil Basu, director, and Mr. B also from PwC. I now request the chairperson of the Direct Access Committee, Mr. Pallab Gupta, who is also an advisor taxation in ITC Limited, to welcome all the delegates and take the session forward.
Good afternoon, all the participants for today's program. We are privileged to have Pricewaterhouse and Company who are holding this program on our behalf. They have kindly agreed to conduct the program. They have done it a number of times in the past, actually. We were actually waiting for the COVID problem to subside. And that is one of the reasons why we did not hold any programs, because we were hopeful that we could do some sort of a physical program where people would... I would suggest participants to switch off their audio. Disturbance is coming. Yeah. We were hopeful of holding a physical program earlier. We were wondering, we were very unsure actually, but in some of the managing committee meetings, there were discussions actually on we could start the programs in a normal way at Bengal Chamber, but things have not really worked out as yet. And we have been advised that at least at this juncture, we should conduct the programs online in this Zoom mode, etc. And maybe next year you may see some physical programs. I really had to push this program quickly because the tenure of the current committee, managing committee, and the president is getting over. As you know, in Bengal Chamber, we have these annual general meetings every year, and really the various committees and the managing committee function from year to year, and we have a president every year normally. This year's AGM is now scheduled on 29th of September, which is round the corner. And that's one of the reasons why I thought that at least let's finish up this year. It's the only program. And hopefully next year things will improve and we would be able to hold normal programs as we have done in the past years. Income tax is a very complex subject. And various developments are happening all the time. As you are aware, even though the budget was presented quite a few months back, but since then also a host of notifications and circulars have come out. The law is effectively being changed and the new things are happening all the time. Now, even on the new issues, it would not have been possible to fit this into a three-hour program. And therefore, when we discussed with PwC, we realized that we cannot cover everything. You must have read in the press and also notifications have come out on the withdrawal of the retro tax of 2012, which was really a very, very whimsical decision of the government. And the government has been kind enough to withdraw it with effect from that date itself. So the notification has just come out on the various regulations, and hopefully the retro tax issues of the past will not last for too long now. But even without getting into those developments, we have enough on our plate for today's discussion. We are looking at the very, very complex developments in TDS and TCS provisions. All corporates and all organizations are struggling now to comply with the changed laws. And TDS has a very, very severe ramification because it cuts through all the payment systems in every organization. And we are really keeping I think we have left about 45 minutes time for that session, which will really try to deal with the complex issues which are arising now. In addition, we will also be covering two other areas which have really taken a very big way. One is the faceless assessment, on which the various systems were evolved, but the government, it was really a massive change in the procedural part, and this submission of online information and really cutting down the physical interactions to the absolutely minimal level. I think this was a very, very bold and extremely revolutionary step on the part of the finance minister, and we compliment her for that. However, issues continue, and there are a number of disputes which have cropped out, even on the procedural part, like really issuing a draft assessment order, personal hearings of the parties involved when they're requesting for it, etc., etc. And the courts are really looking at it, and some decisions have already started improvement in the operating system. The Income Tax Department also is trying to improve on the restructured setup they have. For example, the commissioner level positioning is still going on. The assessments are generally handled by the lower rung of officials, like the deputy commissioners, up to the maximum, up to the joint commissioner level. But the commissioner level postings have just been started. So as we go along, things will keep on evolving. But at least at this point of time, we would be really hearing a lot on the new developments in this area. Reassessment law also was massively changed in this year's budget, the last budget rather. And the finer points were really not understood by a host of tax practitioners. And therefore, we are having a large number of discussions and debates on the subject. So we will be really hearing the new amended provisions on reassessment, and you would be welcome to raise questions, and we will try to accommodate it at various stages at the end of every session, as well as a separate session at the end, depending on the time available. So with these few words, again, warmly welcome you all to the program. And I would request Pricewaterhouse, PwC, to take over now and start the presentations.
Huh?
No, I don't think.
You watching is watching.
Sarvani, I'm trying to present. It's saying host has disabled the sharing. One second. Now I think yeah, now I think it's good.
Yes. Yes, thanks. I can see it. So as you can see, the topic today is amended reassessment provisions. Go to the next slide. So the first thing, what we will cover today is this written in this content. You can just have a look. Because of the sea change, definitely what are the changes, we'll cover that. And then 147, 148, where the changes are. Go to the next slide. So coming to this particular changes, there has been a paradigm shift in the fundamentals on which the entire scheme of reassessment is based. The Finance Act 21 substituted existing sections 147, 148, 149, and 151. And they have also brought in a new section, that is section 148A. So we can see that the sections, all the sections have been substituted and a new section has been brought in. So Deeparun, please go to the next one. Right. Now, if we just compare the changes, so when can notice under section 148 be issued? If we go to the old scheme, we saw that there were two basic conditions required. One is the assessing officer has reasons to believe that income has escaped assessment, and he has to record reasons to believe that the income has escaped assessment. Two things, that is reasons to believe and recorded reasons. So what is the new scheme saying? The new scheme is saying that the assessing officer should have information which should suggest that income has escaped assessment. So this reason to believe, that phrase is no more there, as well as now the main word is information. Now, even in the earlier scheme, as I said, there was recorded reasons which the assessing officer should have written down, and sometimes they communicated, sometimes on the basis of the request of the assessee, they have delivered it. But now that is not there. There is a new section, section 148A, which has been introduced. Now, what does 148A say? It talks about the assessing officer should conduct an inquiry. That is not always. That is, if required, they'll conduct an inquiry. Thereafter, the assessing officer will grant an opportunity to the assessee of being heard. Consider the reply of the assessee and all the materials on the record, and thereafter pass an order. So you can see that this particular thing was earlier not there. Earlier, if you can remember, that a Supreme Court decision in case of GK and drive shafts had stated that when you are issuing a notice under section 148, and thereafter if the assessee is asking for recorded reason, and you have given that recorded reason, and assessee has objected to this reassessment proceedings technically for some reason, have challenged the jurisdiction, then you have to pass a speaking order if you still want to continue with the reassessment. So this is what Supreme Court stated actually. So now, considering that aspect, this section 148A will take care of those things. Now, if I go to the time limit for issuance of the notice, we all know that in the earlier law, under general circumstances, it was 4 years reopening could be done from the end of the assessment year. Any escapement beyond 1 lakh, the reopening could have been done for 6 years, but definitely there should have been an omission or failure on the part of the assessee to disclose material fact was there. And it could have gone till 16 years if income in relation to any asset located outside India has escaped assessment. So in totality, it could have gone till 6 years. So if we see the new scheme, new sections, it says generally reassessment can be done for 3 years from the end of the assessment year, and beyond 3 years up to 10 years if the amount involved is rupees 50 lakhs or more, and the assessing officer has in his possession books of accounts or other documents or evidence which will reveal that income chargeable to tax, and that should be represented in the form of an asset and which has escaped assessment. So these The phrases are very vital. That is, this particular amount which has escaped assessment should be in the form of an asset. So there are a lot of debates with regard to what is an asset that we will come later on. Now, who will be the sanction authority for issuing notice? Earlier, up to 4 years' time, it could have been the Joint Commissioner. After 4 years, it is PCIT or CIT. Under the new scheme, up to 3 years, at the very first instance, it should be PCIT or CIT. And after 3 years, it is PCCIT, Principal Chief Commissioner of Income Tax, or CCIT. So similarly, it can be DIT, PG, DIT. So I have not written that. But so from this particular sanction authority change, one can understand that the person who will be sanctioning for the reopening, is no more a joint commissioner. It goes to the level of principal commissioner. So what comes to the mind is, what is the reason for this change? So factually, the reason is that one is ease of doing business, and the other thing is the less litigation. Now, the more there is litigation, there can never be ease of doing business. So this changes, which we can see over here, is with the objective of reducing litigation and for doing ease of business. And that is what the memorandum has also been stated. The Honorable Finance Minister himself has stated that. Next slide, please. Now, as we said, that reason to believe, okay, this reason to believe has been replaced with information for initiating reassessment proceedings. Now, this reason to believe is a very subjective phrase. It has a subjective proposition. Initiating a reassessment proceeding is often disputed by the SSE. There have been numerous rulings which define the powers of the assessing officers and also have stated what were the duties of the SSE. And various courts have held that they have struck down in some cases where they have found that it was on the basis of some suspicion assessing officer has reopened, or there was no direct nexus between the material in possession and the escapement of income. There was no reason to believe it was a change of opinion. So from all these court decisions, what we could gather is that this is absolutely a subjective proposition. What could have been a reason to believe for an assessing officer may not hold good before the eye of law. So the courts have struck down sometimes it went in favor of them, but this subjectivity they wanted to remove, and that is why they've replaced it with information. Now, one has to see that we all know that whenever this reopening is done, what was required was reason to believe. That has been replaced. Now what is required is information. Now, first thing, earlier we remembered, in case of reopening, a notice was issued. Now, the scheme said that no, before a notice is issued, you remember that section which I showed to you, section 148A, which says that the assessing officer, if he thinks that an inquiry has to be done with regard to this income which has escaped assessment, he will do that, and thereafter he will give a show cause a notice to the SSE and give him an opportunity of hearing. So after hearing, then he will write down an order whether he should initiate reassessment proceeding. So factually, before issuing a notice also, there is so much of work an assessing officer will do. Now, when we say information, what is that information? So it has been stated that any information flagged in the case of the SSE for the relevant assessment year in accordance with the risk management strategy formulated by
Sorry?
the board from time to time.
Hello.
And the second part, they've
Yeah,
said, any final objection raised by the Comptroller and Auditor General of India, that is,
Yeah,
any
yeah. Can I call
objection
after half an hour?
to the
I'm
effect,
meeting actually.
may I request everybody to stay on mute, please? To the effect that the assessment in the case of the assessee for the relevant assessment year has not been made in accordance with the provisions of this Act. Now, when we say that which information can be flagged by CBDT, this is a question that which are the informations that can be flagged, from where will they get it? So these questions come up. So such flagging of the information would largely be done by the computer-based system. It may be pertinent to know which information can be flagged, like whether it should be collected from third parties, or it can be due to some retrospective amendment in the law or court rulings. So why these questions are coming up? Because there have been a lot of Supreme Court decisions where it has been stated that what is the meaning of information? It's stated that information means instruction or knowledge derived from an external source concerning facts or particulars, or as to law relating to a matter bearing on the assessment. There was another Supreme Court decision where it was held that information would include as to the true and correct state of the law, and so would cover information as to relevant judicial decisions. So factually, it can be information from third party, it can be change of law, it can be because of the court decisions. So it seems that the expression information mean the particulars which are obtained from third parties, the court rulings, even the correct interpretation of the provision given by the board. But what is mandatory is this information will have to be flagged in accordance with the risk management strategy formulated by the board from time to time. So suppose there is any information to the assessing officer which definitely he has, and you can see there has been income escaped assessment, but that has not been flagged in RMS, that is the risk management strategy formulated by the board. Then based on that, the assessing officer cannot proceed for reassessment. Now, we all know that earlier, if there was any audit objection, and there are Supreme Court decision, and very recently also on one SLP of Delhi High Court was rejected, stating that audit objection cannot only be the basis for reopening. But now this will stand as an information. Go to the next slide. Now, we have seen that earlier there was an explanation which has stated what do we mean by deemed to have escaped assessment, and that was an inclusive definition stating number of cases. And in this particular new scheme, nothing has been mentioned like that. Over here, what has been mentioned, I have just discussed, and that the list of cases which will tantamount to deemed to have escaped assessment, that has been omitted. Now, one of the points over there was like, if an income has been assessed at a lower rate of tax, then reassessment proceedings could have been done. Now, a question is coming up that suppose if an income has been taxed at a lower rate and the assessing officer can see it, but can he go for reassessment? The answer is he has to pass the information test. That needs to be satisfied. Now, you would find that at the beginning only I said that failure to disclose fully and truly all material facts necessary for assessment, this has been omitted. Straight away what has been done is for general cases, 3 years from the end of the assessment year, reassessment can be done subject to fulfillment of condition. And it can go up to 10 years if the amount is 50 lakhs or more. And of course, the escapement of income has to be represented by an asset. So this omission failure is no more there. Now, suppose if there is a case which I have quoted over here, notice has been issued under section 148 of that on 30th of September 2021 for assessment year 15-16 after following procedures under section 140A. So this is, suppose they have followed it. So as per the old section 147, no notice under section 148 can be issued after 31st March 2020, that is after 4 years, unless there is a failure on the part of the SSC to disclose fully and truly all material facts necessary for assessment. Now, in this particular case, since notice is issued after 1st April 2021, the new section 147 would be applicable, and hence, whether SSC can take an argument that 147 proceedings cannot be initiated after 4 years since all material facts were fully and truly disclosed. So when I'm discussing this with you, there are, these issues have been already have reached the court. And you are aware that there is a lot of litigation going on with regard to this, whether any notice for earlier years can be issued, and if 4 years have passed or 6 years have passed, considering that 10 years time. And also whether section 148A will be applicable, or is it that the old provision will be applicable? If you go to the new scheme, you will find that there is no grandfathering to the new old provision, as well as specifically there is a provision which states that, if anything has become time barred for the earlier years, then that again cannot be reopened under the new scheme. But there are a lot of dispute because of this taxation amendment law, and 2 notifications coming in whether extension of time has been done. So I will not touch upon that because Deeparun will talk on that, but there is a lot of litigation in this aspect. Deeparun, next slide, please. So this 148A has been introduced by Finance Act 2021 with effect from 1st April 2021. So before issuing the notice, the assessing officer should conduct an inquiry with prior approval of specified authority. Now, this is if required, he would do. But see, the main thing is that there is a prior approval required. Now, after this, the assessing officer will provide an opportunity of being heard to the SSC, will serve a show cause notice as to why he want to reassess. Thereafter, the SSC will appear, give his reply, and considering that reply of the SSC file in response to the show cause notice, the assessing officer will pass an order deciding if it is a fit case to issue a notice under section 148. And in this process, there are 3 times where the assessing officer will have to take prior approval from the specified authorities. Now, this itself shows that earlier, what used to happen is when a notice is received and lot of notice was challenged before the court, maybe because of the jurisdiction, because of some administrative requirement. So factually, and why the matter went to the court? Because the SSC's plea was there is violation of natural justice. So probably through this 3 times approval, giving opportunity to the SSC, and so that this approval process is not mechanical. Authorities like Chief Commissioner is involved, Principal Chief Commissioner is involved, Commissioner is involved. So after this, if there is anyone goes to the court and feels that there has been a violation of the natural justice, there will be, if this is properly followed, there will be less chance of succeeding. So earlier this litigation used to appear after the notice is issued. So this is the area where they want to protect and reduce the litigation. I will just say that, whatever I'm discussing is not in relation to search and seizure. It is other than that, because this particular session is for that. So Deeparan, if you could move to the next slide. Now, before going into this, I would just say that go to the last slide. Yeah. So what is this approval? So if we see that, these, number of times going over there, actually the specified authorities have been given some, I would say that they are some responsibility with regard to satisfying themselves that whether it is a fit case to issue a notice under section 148. So factually, the word approval, when it was dealt by Supreme Court, it stated that approval means to agree with full knowledge of the contents of what is approved and pronounce it as good. In other words, confirm authoritatively. So when the power of such approval is vested in any specified authority, then what he needs to understand is that what is there that he's approving. So he should understand what is there in that, and full authoritatively he should approve it if he believes in that. So see, from this approval process, actually, that recorded reason which has been given away, the reason to believe that has gone, but these are actually inbuilt when this prior approval of the specified authority will be given, because it is not permission. There's a difference between approval and permission. Permission, okay, you can just write the word approved, but when it is approval, you have to justify why you are approving. And that is what has been dealt by the Supreme Court, where, though just writing the word approved, they had rejected, saying that that was a mechanical application, and there was no application of mind. So these are the areas one will have to see how the income tax authorities deal it, because if they really apply their mind and approve, then definitely the objective will be met and there will be less litigation. Go to the next slide. Now, as I said that this section 148A, that new section, is applicable from 1st April 2021. So the question is coming that if any notice is issued for earlier years, then will section 148A be applicable? Or is it that the sections which were prevailing earlier to this new provision, those will prevail? So the answer is, I would say there's a lot of debate going on with regard to this, and matters have reached various courts, where very recently one court have given a negative decision against negative decision in the sense it's against the SEC, but most of the courts have admitted it, and prima facie given some view also, stated some line in favor of the SECs, but nowhere they have decided anything. So I will leave that on Deeparun when he will be discussing on the timeline to discuss in more detail. So Deeparun, over to you to take through the timeline.
Thank you, Sushanadi. Trust I'm audible?
Yes, you are audible.
Thank you. Okay. Thanks, Sushanadi, for setting the context and starting the topic. And good afternoon, everybody. Continuing with this change in the reassessment proceedings, what Sushanadi just now discussed were the procedural aspects and other thing. Now, what we are starting to concentrate here is the time limit for issue of the notice. So, as was initially discussed, there was initial timelines which was mentioned in the erstwhile reassessment scheme, which was there in the existing Income Tax Act. And with this Finance Act, the last one, the entire timelines were changed. So what was changed is replicated in the right side of the slide which you're seeing now. Basically, it says that the default timeline is 3 years from the end of the assessment year. That is the timeline for issue of notice. However, you can issue the notice till 10 years. However, there's a subject to conditions like the assessing officer has to be in possession of books of accounts or other documents, which proves that, which reveal that income chargeable to tax has represented in the form of asset and which has escaped assessment. And such assessment is likely to exceed 50 lakhs rupees in a particular year. So that is a condition precedent for extending the timelines from 3 years to 10 years. So earlier basic timelines were 4 years and it could have extended to 6 years, provided there was a failure on the part of the assessor to materially disclose something. Currently, it has been revised. The default timeline is 3 years. And if these conditions which I mentioned here, if those are satisfied, then it goes up to 10 years. So basically, these comes in the form of two subsections. It comes under 149. 149(1)A gives the time limit of 3 years. 149(1)B gives the time limit of 10 years. Now, let us go and see what are the other nitty-gritties of the timelines. Again, if you notice to the right side of the slide, there is a very important proviso which has been inserted in the new section, which says that no notice under 148 can be issued for any assessment year for on or before 1st day of April 2022. That is assessment year 2020 or before that, no notice can be issued if such notice could not have been issued at the time on account of time being beyond the timeline which is specified under the erstwhile section. So if you're dealing with these assessment years, that is assessment 21, 22 or prior to that, and if the department is trying to invoke the new section to issue notices, and they're trying to invoke, say, the 10 years time limit to issue the notices, then they have to look at the erstwhile old section also. And if they find that these sections are covered there, for example, the maximum timeline covered there was 6 years. So they have to limit themselves to that 6 years, specifically for assessment years up to 21, 22. Beyond that, obviously, the new section becomes applicable. Then only the new section, that is 3 years and 10 years. But for this till assessment year, the Income Tax Act revised one has limited the powers of the assessing officers to say that because there is already an existing section and there are some particular timelines given under that, you cannot issue a notice with the timeline which goes beyond that. So if 6 years was given there, you have to stick to that, in spite of the fact that under the new section, you may have a right to issue it within 10 years, but you cannot do it in 10 years. It goes back to 6 years here. So that is an important provision which is given here. Now, so there is this plethora of old section, new section, etc. Earlier 4 years, 6 years, and now it is 3 years.
76 টাকা 90 তাই তো আর 67 টাকা ওটা তাই তো প্রতি মাসেই তাই ধরছে তাই তো
Can I request others to be on mute, please? Thank you. Okay. So as I said, there is a plethora of sections and there is a plethora of timelines. So we have just tried to put a flowchart here to see in a lucid manner, in a pictorial manner, whether we can understand it. So here where we are referring to 149(1)B. So we are referring to a scenario under the new law, where by default, the assessing officer, after satisfying those conditions, gets a right to issue under 10 years. If you do not satisfy 149(1)B, that is, you do not have in your possession information which you believe has led to a concealment of income which is in excess of 50 lakhs and represented by asset, then you go to the right side, notice cannot be issued after 3 years. Assume the assessing officer satisfy the conditions, then you go down. Then you have to see, as I said, which assessment year does it pertain to? If is the concerned assessment year 21, 22 or earlier? If the answer is no, then obviously you come completely under the purview of the new section or the new provisions. Then the maximum timeline available to the department is 10 years to issue the notice. Now assume, yes, you do fall within the assessment year 21, 22 or earlier. Then what happens? As I said, the new section has a provision that gets kicked in, and thereby the maximum timeline which you have to go to the old section and see, was the maximum timeline available at that point of time was 6 years. Yes, if you see that under the old section, the maximum timeline available for issue of notice was 6 years, then you cannot issue the new notice beyond the period of 6 years. And if it is gone, then you cannot issue a notice under 148 at all. More, mind you, I keep referring to the old section and keep saying 4 years, 6 years. There's a very typical scenario under the old section which says if you have a foreign assets, etc., the timeline goes to 16 years. So I'm ignoring that is very typical case in a day-to-day basis. We only see 4 years and 6 years. So here is a scenario 21, 22. Even if you have right till 10 years to issue notice, but you can invoke the provision and say under the erstwhile sections, you could have issued it only till 6 years. So you limit yourself to 6 years itself. Moving on. Now, this is interesting. We briefly touched upon this. See, we are living in a pandemic era. I mean, thankfully, I think we are getting out of the pandemic now, but our laws and legislations are affected by it. And if laws and legislations and our lives are affected, then income tax by itself cannot be free from it. So as the tax fraternity knows that over the period of time last year or say 1.5 years, whatever, there has been substantial number of relaxations or extension of timelines that has happened on a periodical basis, sometimes through notifications, then an ordinance, etc. But specifically an act was issued. The act here, which is given in the first line itself, it says Taxation and Other Laws, Relaxation and Amendment Act of 2020. Lengthy name, I'll use the name TOLA for subsequent references within this presentation. So TOLA was issued and it gave power via that act to issue or rather give extensions to the existing timelines under the various acts. So first question is whether Income Tax Act also gets covered under it. The answer is yes. There's a particular section under TOLA which says that what are the specified acts by which this TOLA can impact and increase the timelines provided. So Income Tax Act is an act which is affected by TOLA, and thereby the timelines under the Income Tax Act can be extended by it. Now comes the more interesting question. What are the timelines or what are the dates that did the specify? What are the dates which TOLA specified which can be extended? Which is given in the first fourth bullet of the first section here. When TOLA was introduced, it said the extensions will be provided for all the specifications and notice to be issued and which fell due within a period of 20th of March to 31st of December 2020 or such other date after 31st of December 2020 as may be further extended by notifications. So as you know, pandemic is a moving era. Government also did not know what we are looking at when the pandemic situation gets over, where everything goes normal. So when the act was introduced, they said 20th March to 31st December 2020. But also they gave a specific dispensation saying that we can also extend other timelines which is falling beyond 2020, but that is through specific notifications. So now post TOLA there are several notifications issues. So now there are 3 important notifications which is given here. So when you are looking at this timeline, 20th March to 31st December 2020, first
টোলাটা কি রেট্রোস্পেক্টিভ অ্যাক্ট যেটা তুললো সেটা?
Yes.
টোলাটা কি বলছে? রেট্রোস্পেক্টিভ অ্যাক্ট যেটা তুলে নিল সেটাই?
Is that question to me? Okay, I'll move on. Okay. So there are 3 subsequent notifications to that. So first of all, the deadlines were increased first to 31st of March 2021. Then through the second notification which came on 31st of March 2021, the deadlines were extended till 30th of April 2021. And the last notification which has come had extended the deadlines to 30th of June 2021. So these are the overall limits. Last one is 30th of June 2021. So 2 dates become very important here. Whenever we are saying timelines for issuing a notice for 149, it falls due on the last date of the particular financial year, right? Because say 4 years from the end of the assessment year becomes March something. So within this period of extension, there will be 2 days, 31st of March 2020 and 31st of March 2021. White TOLA and the subsequent notifications, both those dates ultimately gets extended to 30th of June 2021. So whatever fell due on those particular dates, department can still say that these are extended to 30th of June 2021. There are other questions involved on it. We'll see what happens in subsequent slides. And now, as I said, the TOLA was introduced as an act, and then there are subsequent notifications which further extended the deadlines which is specified in TOLA. And there's an important explanation which is given in the notification. What does it say? It says that for the removal of doubts, it is clarified that for the purpose of issuance of notice under 148, as per time limit specified under 141(9), or sanction under 151, or the procedures provisions mentioned in 148, 149, 151, etc., as the case may be, as they stood as on 31st of March 2021 before the commencement of Finance Act shall apply. So basically what the perhaps they're trying to do is that, remember till 31st of March 2021, the old 147 or reassessment provisions were in vogue. So they are perhaps trying to protect the entire reassessment provisions by inserting this explanation in the notification. So that is perhaps was the objective of the department, but we will see what is happening because of this. So we have tried to capture what are the timelines which are respective here, because we have seen that various SSCs have been receiving notices. So now, as I said, if it is something like 31st of March 2021 was your deadline, now what is happening? Old Act was prevailing till 31st of March 2021. But because of the extensions provided to TOLA, we saw that certain notices were issued even after 31st of March 2021, but within June 2021. And those were as per the old provisions. So now we have three kind of scenarios here. What are the possible scenarios? What are the timelines that may possibly apply to a particular notice? Number one, under the old provisions. So as I said, the old provisions dates were 4 years and 6 years. Number two, the new provisions may apply. And there also there are 114 in 1A and 1B. So the by default under the new provisions, it is 3 years. However, if you go to the 114 in 1B, the default right is 10 years. But here in this pictorial depictation, we have kept till assessment year 21-22. So therefore, as I said, you have to refer back to the old provision and your timeline gets limited to 6 years. So here we are looking at a scenario, old provisions 4 years, new provisions 3 years. And if it goes to 149 in 1B, everything falls back to 6 years again. Now see, these timelines which I mentioned, I just take an example. For example, say assessment year 12-13. Old provisions, the default timeline was 4 years. So it is time barred on 31st of March 17, gone. If you're looking at new provision, again, it is 3 years from the end of the assessment year, 12-13, 31st March 16 was the deadline, again, time barred. Even if you go to 149 1B, as I said, 6 years will be the timeline applicable, be it under the old law or the new law. So it was still 31st of March 2019. That is also gone. So that's a very simple case of 12-13. Like this, if you see, all other provisions are mentioned here. The calculations are same, so I'm not repeating every assessment here. But what is important here is that the yellow marked boxes which are referring here, because in all these cases, the normal time limit for issuing of notice was either 31st of March 2020 or 31st of March 2021. So by the normal scheme of things under Income Tax Act, whether be it the old one or the new one, these would have been and should have been time barred by those 2 days, 31st of March 2020 or 21. But because of TOLA, both those days now has got extended to 30th of June 2021. So effectively the timeline has got extended to 30th of June 2021. So that is the timeline here. I'm not spending time on the other things, but the yellow mark questions are important because that extends the timeline because of TOLA. 151, I think adequately has been dealt by Sushmita. The approval letters needs to be taken if it's less than 3 years from PCIT or principal director or CIT or DIT. If it's more than 3 years, it has gone up to principal CCIT, principal DGIT or CCIT or DGIT. So there are much stringent approval requirements now. So now the question is, see, when I mentioned TOLA, I said that all those timelines are increased. But when you are explaining reassessment provisions here, it is not only a question of timeline. There are substantial other things which has been changed. The entire procedure has been changed. There is section 148A which says that now the assessing officer requires to collect information if necessary before issuing of notice from the SSC. Then the SSC will be given an opportunity for personal hearing. And then the assessing officer has to pass an order giving reason why he is trying to issue a notice under 148. That was not the case under the old provision. Then so this provision is to be followed. The approval requirements which we just said are much larger and there are 3-step approval. Whether those approvals need to be followed. The approval requirements under the old provisions were different. And also, as we said, earlier section only said reasons to believe. Now we have things like whether the assessing officer has something in his possession or it is flagged by the information in the risk management procedures. So basically, I'm trying to say on one end, you have the timelines. On other end, these are very subtle and important points of procedural aspects which are there. So assume the department says that now they're issuing notices post 31st of March 21 till June, but they're saying these are under the old provisions. So they're issuing notices within the timeline. But the problem is they have not followed any of the procedures which have been mentioned in 148A or the other sections. Now, the moot question which is arising here is, though the timeline by itself may have been extended by TOLA, but whether those procedural sections have already been given up with, that is the question which is raging over on this country. And we have seen plethora of cases which has already reached various high courts in the form of writs, etc. The matter is still sub judice, and we are seeing various kinds of views, preliminary views which are emerging. Some of the high courts have said that they have expressed a prima facie view that yes, perhaps TOLA does not give a right to the department to not to follow all those procedures which has been given under the new provision. They have to stick to those, but those are only preliminary views, and they have given a stay to the initial notice being issued. And however, we have to see how the proceedings emerge. And as Sushmita mentioned, there has been one negative ruling very recently. This week only we got it. There, the court has taken a view that perhaps TOLA does give the right to department not to follow those procedures, but we don't know what is the fate of that ruling. Also, we have not seen whether that has gone to the division court or not. Time limits are still there. They may file an appeal to division court, but we don't know. And how this entire scenario emerges, we have to see. So, as I said, what were the SSCs doing when they got a notice? Say the notice was issued beyond 31st of March, but within 30th of June. So there are two processes which you normally know and the litigation is available. So normally, if you get a notice, do comply with it. You can raise technical issues there also, or on merits also. And then after you receive an order, if you get a negative order, you go to CIT appeals, and the normal process of litigation goes on. However, as I said, this entire scheme of income tax new reassessment and TOLA gives rise to very, very important procedural and technical questions. So one may also explore whether you can go to the High Court by filing a writ and challenge this thing. So what all can be seen? What all can be challenged? Whether you can challenge the time limit itself. And as I said, if you say that yes, TOLA gives an extension to time limit, so you can issue within that time limit. But whether you can challenge the procedure itself, whether the procedure mandated by the new provisions have been followed or not. So that's a very big challenge you can do. And in all those writ petitions, we've also seen, they have also challenged the effectiveness of the explanation of the notification and TOLA in itself. The moot argument there is that the notifications insert an explanation and notification, whether this is a piece of delegated legislation, whether they can override the main act in itself and thereby extend the time limit, and thereby also do away with all the procedural requirement which are there, which are required there under the new reassessment provision. So this writ vis-a-vis the normal process, a very, very fact-specific and sensitive scenario that needs to be seen. Various factors involved. What is the speed you want a disposal? What is the cost involved? Based on your particular case, what is the certainty that you can get a favorable order, etc. Which court you're looking at? Where are you approaching through? What are the strengths, etc. If you are going on writ, we have seen that this pandemic has been a moving era. There has been substantial notifications now and then by which the Income Tax Act gets amended itself. So now I currently don't know what is the act. We have to read along with notification. Even if you file a writ, whether there will be an retrospective amendment to overthrowing all those merits, etc., also needs to be seen. And before getting or complying with the notice of the assessing officer needs to be kept in mind, because once you comply, the writ remedy becomes a little tricky. So all these things are going on, but we have a substantial distance to go as far as litigation is concerned in this case, because we are seeing these cases emanating, and we have to wait and watch how the various high courts of the country react to those kind of writs finally when the final orders are coming. I think with that, I am ending here. So either we can take questions or we can take questions at the end and the next session can start.
Thank you. We now move onwards to our next technical session on TDS, TCS, and newly introduced provisions like 194Q, 206AB, etc. I now request Mr. Kapil Basu, Director PwC, to take the next session forward.
Thank you. Thanks a lot, everyone. Thanks, Sushmita ji, Diparun, for your session. and also Mr. Gupta for the wonderful preface and actually setting up the context on what exactly we are talking about, the present situation with the dynamic tax laws. I would say principally the tax laws are changing and we are seeing a lot of movement in the tax laws and need to be abreast on a regular basis. So is my screen visible?
Yeah, it's
as of now?
visible.
Yeah, okay. So today's discussion is on TDS and TCS provisions and the recent development of those. As we know that as per the Finance Act 2021, there were a couple of changes in the TDS and TCS matters. The major being the introduction of 194Q, that is deduction of tax on purchase of goods, and also a couple of section which is a bit penal in nature to penalize non-filers as such. There were certain other sections also in TDS, but those are not very relevant or not very important maybe, such as FIIs getting benefit of double taxation and in zero coupon bond and all. But our today's coverage is basically revolving around the TDS on purchase of goods and its allied provisions. Now, before we dive into the session, firstly, just to take a step back and understand the fundamentals of TDS, and it's very relevant in today's discussion, because why is TDS required? Now, TDS is required basically as a tax which goes to the government during the year. It's a cash flow issue, definitely matter, and also the fundamentals of TDS is basically pay as you earn. So as you are earning income, you keep on paying the taxes, so the cash flow of the government is also in sync with the income you are generating. Now, while we are on this point, we would see that the TDS chapter 17, D has four, I would say, sectors. 17B deals with deduction of tax. BB deals with tax collection at source. Then there is advance tax of payment, and D is recovery of tax. So while we take all these four items, we would just go to the legislative journey of TDS and TCS, how it evolved over the years. So when we say the TDS, it started even well before 1961. So we are just putting our starting point here. So TDS has always been there as you pay as you earn. Then in 1988, the government felt that there are a couple of sectors which are a bit unregulated, such as Hindu leaves, timber, etc., wherein the people who are buying stuff or scrap, and thereafter coal also came up, that they were not paying taxes. To control those unregulated sectors, they had the TCS provision was brought in, wherein you were paying taxes while you were buying and you're not paying as you earn. So it was an exception to the rule based on which TDS fundamentally stands. Thereafter, in 2020, it was felt that you would see that the TDS and the TCS section TDS section deals with the service portion, and supply of goods is a major portion which is not covered. Now, to curb, I would say, black money and all to control the widen and deepen the tax base, it was felt that the supply of goods transaction has to be brought into the information net, and hence a minor 0.1% of TCS was applied in respect of supply of goods. Now, that created a major challenge for a lot of people, because TCS is a provision which is very hard to implement because it depends on the collection. Whereas a supply of goods, a sale would happen, but the collection may happen in a subsequent year, and you all would have experienced that what has happened over the last 1 year to even implement TCS, to even understand TCS, and hundreds of notifications coming based on that. To see, I would say, control this situation, the government came out with a provision that let us not have it as TCS, let us have it at TDS. By so that got the TCS provision, I would say, got rationalized, and now we have a TDS on supply or sale of goods, which brings us back to the fundamentals of pay as you earn, number one, and secondly also meets the objective of taking information or getting information in respect of sale of goods. So when what we say that ek tir se do nishan, we at least got that thing from here. So now coming to the section that 194Q, this is applicable from 1st July 2021. So what does the provision say? That in case there is any purchase exceeding 50 lakhs, then one needs to see that when there is a purchase of goods from a resident person, the goods are purchased for a value aggregating exceeding 50 lakhs, and the person, his business turnover in the last year, in the preceding year, was more than 10 crores. There are certain exceptions. The exceptions are TDS. If TDS is deductible under any other section, then this will not apply. If TCS is collectible under any other section, this will not apply, excluding 206C1H, the one which was there till last year. Now, just to break it down, we would see that this section has three major limbs. There's got to be a big buyer, there's got to be a big seller, and there's got to be purchase of goods. Now, what do you mean by a big buyer? That is a person who needs to deduct the tax. And that person would be a person who had 10 crore of business turnover in the preceding financial year. Now, just to dive into the big buyer thing, just a minute. So the big buyer will be the deductor having more than 10 crore business turnover in the previous year. Now that person, if that person is a non-resident buyer, then what happens? Then there is a circular that if it's a non-resident buyer, this 194Q will not apply, except if that non-resident person has a PE in India, permanent establishment in India, and permanent establishment has been defined to include a fixed place of business from which it is carried on. So if a non-resident has a fixed place of business to carry on business in India, then 194Q will apply to that person. Now it says fixed place of business. There are other types of P. We know that there is service P, installation P, whether those types of P would also come into place. Seeing the definition and also seeing a similar judgment of the Supreme Court in the Morgan Stanley case, it's being an inclusive definition. The other P's which are there, which is mentioned in the respective treaties, like installation P and service P, may also come into place, and any non-resident having any sort of P in India would rather trigger 194Q. Now, when we talk about business turnover only, we say that it's sales turnover, gross receipts, business exceeds 10 crore in the immediately preceding year. So we need to ignore all the receipts of non-business activities. And one would say, if it is my first year of the company, then I don't have any preceding previous year. Does 194Q apply to me, even if I am a, say, 1,000 crore turnover company in the first year? So there is a clarification which says that no, in the first year of incorporation, since you do not have a preceding year, you are exempted from 194Q. Just a numeric example on this, that say a buyer 1 has received from business activities of 12 crores in the preceding previous year and receipts from dividend and interest, then 194Q would apply. However, in case buyer 2 has a similar 18 crore of gross receipts, but 6 crore in business and 12 crores in dividend or interest, then 194Q would not apply. Taking the third example as well, I don't have any business activity, and maybe I'm a holding company, holding a sister, all the companies in my group. So I'm set up as a holding company itself, and I don't have any business income as such. then 194Q would not apply to me. But these are very fact specific. There can be situation where income which seems to be in the nature of dividend, interest, or of similar nature can be termed as business income. Those aspects need to be seen. We do this analysis when we do the tax audit report. We find out whether what is the income from PGBP. So that same analysis may be taken into account while we are thinking of this threshold. Coming back to the second limb, that is, there's got to be a big seller. So once I am sure that I'm falling within this bracket, I'm a big buyer and I am a deductor, do I need to deduct 194Q on all the purchases I make? No, I need to see that from that seller whether I am crossing 50 lakhs during the year or expected to cross 50 lakhs during the year. Then only that seller becomes relevant for me to deduct a tax under section 194Q. Now, residency of the seller, that first, when I identify the seller, that seller must be resident. So if I'm buying from somebody non-resident, then 194Q does not apply. Now, what will be the 50 lakh, what will be the coverage of threshold of timeline? Since this law starts from 1st of July, there was a school of thought which was thinking that should I start counting for purchases from 1st July onwards? A clarification has come in this regard which says no. To find out the threshold, I need to calculate from 1st of April till 31st of March and then find out whether 194Q applies to me or not. If we see this illustration, we would find that if I've purchased 40 lakhs till 30th June and 20 lakhs in July, then my total purchase is 60 lakhs. I've crossed the threshold and I need to apply 194Q on 60 lakhs minus the threshold amount of 50 lakhs, that is on 10 lakhs. In the second example, I had already purchased 60 lakhs till June and I had made purchase of 20 lakhs in July. So my total purchase is 80 lakhs. So I need to do 194Q, but on how much? Is it 80 lakhs minus 50 lakhs? That is 30 lakhs? No. Since July, I have done purchase of only 20 lakhs. So 194Q will be applied on 20 lakhs only and not on the 30 lakhs. Similarly, in case I have made a single purchase of 1 crore in July, the entire falls into the bracket and I apply TDS on the 50 lakhs, that is 1 crore minus 50 lakhs. Now, can a seller apply for a lower tax certificate? With the advent of 194Q, there has not been any amendment made in section 197 and hence there is no enabling provision for anyone to apply for a lower withholding certificate under 194Q. So as of now, there is no opportunity for applying for a lower withholding certificate under section 194Q. Now coming to the third and the most relevant, and I would say it will be the most debatable one going forward, that there has to be a purchase of goods. Now, what is goods? The Income Tax Act does not talk about goods at all, rather does not define goods. Now we have to dig into various other provisions, various other acts to find out what is goods. Now if we go to the old act of 1930, Sales of Goods Act, it says movable property, stocks and shares, etc., and does not include money or actionable claims. The CST Act 1956 is on the similar lines. As so is the GST Act, similar lines with certain changes, but it's got to be a movable property, but securities is excluded. We'll just hold a thought for securities. We'll come back to it a bit later. But when we see the Supreme Court's decision, when they dealt in a lot of cases, in TCS case, which we would see that there was a principle laid down that what is goods? It's got to be article or a thing or a tangible or intangible which can be transmitted, transferred, delivered, stored, processed. And it can be bought or sold. It has a utility, it has a marketability. So from this, we can at least frame something in our mind that what parameters a goods would have, and if these parameters are met, it could be within goods and 194Q would apply. So coming back to the aspect that whether electricity or whether securities are considered as goods. We just now saw in the GST Act that securities are not goods. Now, coming to this aspect, you would see that there was a CBDT circular which had come and said that transactions in securities and commodities traded in recognized stock exchanges excluded from the terms of goods and 194Q. Now, what do you exclude? You exclude that only which was initially intended to be within the definition of goods. And hence, the logic would say that securities would then fall within the ambit of goods and liable to 194Q if it is not traded through the stock exchange. Similarly, for electricity, is it goods? There are decisions, there are principles laid down that electricity is goods as such. And also that argument finds further support when we see the exemption provided to electricity and energy certificates traded through power exchange. So once they have excluded electricity traded to power exchange, so if it is not done through power exchange, then such electricity is considered as goods and within 194Q. Now, a very, I would say, old argument which comes up that business undertaking, is it goods? Now, there has been a lot of debate on this aspect that because business is comprised of tangible and movable property, and it should be goods. But business as a whole is an intangible property, and whether it's goods or not has been the matter of the debate. And the Honorable Supreme Court in the pre-GST era, while dealing with sales tax cases, have held that no, business undertaking cannot be termed as goods. Similarly, in GST law also, it says business undertaking transferred on an ongoing basis is excluded from supply. So on reading it together, one would say that business undertaking may not be considered as goods for this purpose. Although there is no specific clarification on this point, any view which can be taken, definitely it can be litigated, but there is definite support from judicial precedents that business undertaking may be considered outside the ambit of goods. Now, there has been debate on coupons, Sodexo coupons and similar companies' coupons which the companies purchase, and thereafter these coupons are used to buy goods. Whether purchasing these coupons and not the actual goods is will be considered under section 194Q. So there is a Supreme Court judgment which it was in the case of Octroi that whether this will be considered as goods, and it was held that Sodexo coupons are not goods because this gives the right to a person to buy goods using those credits. So since it is not good, Octroi would not be applicable on that, and similar logic can be used in 194Q to say that 194Q may not be applied when we are procuring Sodexo coupons. Now, coming to the, when we have dealt with all the three limbs of this 194Q. So when all the three boxes are ticked, then 194Q gets triggered in. There are certain other clarifications which had come that if there is any advance paid before 1st of July and then the purchase happens after 1st of July, what will happen? So we know that TDS under section 194Q applies within payment or credit, whichever is earlier. So in this case, the payment has already happened. So before 1st of July when 194Q was not applicable. So the incidence of TDS has already happened when it was not applicable. So there will be no TDS when the credit happens. Now, what is the impact of GST? It's a bit interesting that if the GST is separately indicated in the invoice, then you need not consider while you are calculating the threshold as well as the TDS. But if it is not included in the invoice, then you have to consider the entire invoice value for the purpose of TDS. Now, when does the GST will not be considered in the invoice? Most probably in case of a pro forma invoice for advance payment. At that time, a lump sum amount will be provided and GST will not be mentioned in that. At that time, the TDS has to be made on the entire amount, irrespective of presuming that something would have been GST in that. Just coming to an example on this, that say for example in situation A, I had a first purchase of 20 lakhs and the second purchase of 31 lakhs. My total is 51 lakhs, seems I have crossed. But the first was I had got an invoice which had 17 lakhs of base value and 3 lakhs of GST. And the second was maybe I got an advance payment totally. So I will consider 31 in the next one, but in the first one, I will consider only 17. So my base value comes to 48 and I'm not crossing that 194Q trigger of 50 lakhs and hence it's not triggered. In the situation B, I have a similar 20 lakhs, that is 17 and 3, but the next purchase is of 30, next payment I've got of an advance amount of 35 lakhs. Here I have crossed the base value, that is 17 plus 35, and on the 2 lakhs amount, 194Q will be applicable. Now what now in case of purchase returns, so when I'm purchasing and I don't get the payment immediately, I'm purchasing and credit is made, TDS would be made immediately. Now, if the purchase return is done, so I've already deposited the tax to the government. It is there is a clarification which says that I can adjust this TDS with the subsequent purchase from that party. And in what happens if there is no further purchase, then one has to, there cannot be any refund of that from the buyer. The person has to claim in its return. And in case there is a replacement of goods, then there is no question of TDS getting adjustment. Now, there can be a question of discounts and incentives. Now, if it's a trade discount, it's a reduction in price of the goods, then it's a direct reduction in the purchase credit itself. So only in the net amount, the 194Q will be applied. But what happens in case of an incentive or a cash award when I reach certain amount or something? So it's an incentive which is payable to someone and it is not a reduction in the price of purchase. So in that case, the purchase amount has to be recognized for the purpose of 194Q. So these are very specific cases. So in case of discounts, incentives, one needs to be very careful to see that whether it's a trade discount or it's a cash discount which is coming up, because the implications may be different in two stages. Now coming to the interplay of TDS and TCS, as TCS is applicable on all sort of supplies and now TDS is applicable on supplies as well, there would be a lot of transaction which has TDS and TCS. So what do we do? So when I am purchasing a goods, what am I need to do? So this is a step plan. So first of all, I need to see whether I am a buyer and I had a business turnover exceeding 10 crore in the previous year. I'm purchasing goods in the current year from that seller above 50 lakhs. If the answer to that is no, then 194Q is not applicable. I need to, the seller would be checking whether 206C1H is applicable or not. So 194Q is not my cup of tea then. But if I fulfill these two conditions, then I need to see whether this transaction is, whether other TCS or TDS sections are getting attracted to this transaction. If the answer to that is yes, again 194Q is out of question. But if the answer to that is no, then 194Q is, we would say that it is getting triggered. Now, while it is getting triggered, what are the things which one needs to see? First, I need to see whether the seller has furnished a PAN or not. If he has not furnished a PAN, then straight away 5% TDS on the amount exceeding 50 lakhs. If he has provided a PAN, then I would see whether the seller is a specified SSE or not. The specified SSE is a new thing which is coined, and we will discuss about it a bit later, whether he is a specified SSE or not. If he is a specified SSE, so if he complies with that, then I'll go to the next tab. But if he's considered as a specified SSE and he's a non-compliant SSE, then again 5% TDS will be applicable. But if he's a compliant SSE, then the TDS would be 0.1% on the value exceeding 0.5 crores. Now, going back to this thing, there will be situations where a transaction would be attracting 194Q as well as 206C1H. What happens? It has been clarified by the CBDT that the TDS would be applicable under 194Q. However, in case due to any reason 206C1H had been applied or is applied for any reason, then I need not apply 194Q. That raises a question that does the assessee has an option to opt between 194Q and 206C1H? The answer to that is no. It has been very clearly clarified that there is no option. If both of the things are on the table, then it has to be 194Q that has to be applied and not 206C1H. Going to the next one, 194Q and 206C apart from 1H. Then 194Q will not apply, 206C will take precedence. Now this brings us to a very interesting situation that when I purchase coal, I am required to collect tax under 206C1. There is a subclause which says that if there is a declaration under section 1A that this coal is used for the manufacturing process, then the tax is not required to be collected under 206C1. So there is a dispensation given if coal is used for manufacturing process. Now the question comes up, so then does it mean I am going outside the ambit of 206C1 and hence now 194Q will apply? So there is one school of thought which would say that coal per se is an item which is under 206C1 and hence it is always a transaction of purchase of coal would always be outside the ambit of 194Q. It is a separate issue that there is a dispensation given within the ambit of 206C1 that you need not collect the tax if you give such a declaration. So that does not take 206C1 out of the question of the act itself. However, there would be another school of thought, mostly from the revenue side, that since I've given this declaration and 206C1 is not applicable, so one can say this section is not applicable or collection is not applicable, so I would go to 194Q and tax is required to be deducted. Definitely debates would come up and we would see this getting finalized in due course, but in the time a decision has to be taken by the business which one to take. It will definitely depend on the risk appetite and also need to consider that 194Q, whether it has any implications, even if I agree to a 194Q TDS, whether it will have a cash flow situation or something like that, or whether it can be used as a credit, because default in TDS would mean I have to pay that tax, number one. Secondly, there is a possibility of disallowance as well. Now, just to refresh our memories to what 206C1H was, it's just a snapshot of what this section talks about. That response 194Q is for buyers, 206C1H for sellers, although it seems that 206C1H would not be used much because 194Q has the prevalence over it. But the most important part here is actually there are some specific exclusions also, that for 194Q that if the seller is non-resident, the buyer is specifically exempted by way of a notification and so on. Where the goods in 206C1H, where the goods are exported out of India or goods are imported outside India, so there is specific exclusions given in that way as well. But the most important part which comes in is when we are talking about this section, we will be dealing in detail that there is a higher rate of tax in case the seller is a non-compliant in case of 194Q, and in case of 1H if the buyer is non-compliant. So what do you mean by non-compliant? This new section which has been introduced, it says that in case any person, any payee who has not furnished return in its two immediately preceding financial years, or for which the time has been time limit to furnish return has not been expired, and the payee has suffered TDS aggregating to more than 50,000. So they are trying to capture a situation that where a person who has suffered TDS above 50,000 in both the previous year and has not filed return in both those previous years, that person will be considered as a non-compliant assessee. Now, if the person is a non-compliant assessee, that person would be suffering tax deduction at the rate of 5% instead of that 0.1% or any other rates. Actually, we are talking about 194Q here today, so it will be 5%. But if it is in any other TDS section, they fall under, say, for example, the normal rate is 10% anywhere, then the rate will become 20% for that person. So, but the aspect which comes up here is the same thing is there for TCS as well. 206 CCA, it's somewhat exactly the similar, where the buyer is a non-compliant SSE and he has not filed the return in the previous year, and that person has TDS more than 50,000 in those years. So this logic has been prepared very, I would say, thoughtfully, that a person having TDS or TCS above 50,000 would be a person who per se would have had an income of over 5 lakhs in that year, considering a TDS average TDS rate of 10%. So a person having more than 5 lakhs of income should have filed a return. So that's the thought process, and he should have filed a return. And hence, if they have not, then that person becomes non-compliant. So what happens if they are non-compliant? Then the rate of 5% would apply in case of 194Q, and in other cases it will be twice the rates. Now the issue which comes up here, that how do I understand that tax is required to be deducted at a higher rate, or whether that person is non-compliant? It becomes impossible for someone to even identify that whether a person had filed return in the previous 2 years. It would have become a massive compliance burden for a lot of people to do that. Now what has happened is the department has come up with a compliance check facility. I would say it's a welcome move. Otherwise, God only knew what would have happened in getting the compliances or getting the declarations from people who have filed return or not in the earlier years. So there is a CBDT circular which has come up with respect to the compliance check for this section 206 AB, 206 CCA, wherein we can identify that whether a person is a specified person or not. Now, what do you mean by a specified person? The specified person is a person who has been non-compliant for the preceding 2 years and had TDS more than 50,000, TDS or TCS more than 50,000 in the preceding 2 years. So that person is considered as a specified person. I would, for the sake of this discussion, I would say that a person who is non-compliant would be considered as a red channel person, and a person who is compliant would be considered as a green channel person. So the logic of this functionality has also been explained. It is very useful. It makes us understand that in case I become a red channel person, then how do I get out of that red channel and become a green channel as soon as possible? Also, it is also required to check. It also says that I need to check at the beginning of the year. And if I am a green channel at the beginning of the financial year, I need not worry till the end of the year that I will be remaining green channel for that 1 year for sure. Now, CBDT notification issued on 22nd June has also indicated the process through which this compliance checklist can be obtained, how it can be downloaded, or how it can be done. There is a illustrative manual given in the website of the Income Tax Department, and it gives clear guidance on what exactly needs to be done. So we have just incorporated that guideline in our presentation. We'll just take you through in the next couple of slides. That first of all, you need to reach the reporting portal homepage and click on the register button. And I will just change the pointer if it looks better. So it's the register button. And then once you do it, you have to enter your TAN. Now, you must ensure that your TAN is already registered in the e-filing website. In case your TAN is not registered in the e-filing website, you have to first register from here and then again come here to put your TAN number and click continue. So once you click continue, you come to this page. It opens up actually, and in pending actions, e-proceedings, you would find reporting portal. You press e-reporting portal, or this window comes up. You have no other option but to click proceed. Then there are a couple of options. You click on the new registration here and then click continue. Here you need to see, now you're doing the compliance check. So it's a compliance check, tax deductor and tax collector. And you put your entity category, that is say company in this instant case, and put the company details. This will be the company details you need to do. And you have to add principal officer. Once you press add principal officer, this form comes up. Here the principal officer's details need to be put. Once you enter the PAN, almost all the details gets auto-filled, and then you press submit. Once you press submit, it is registered, and you can download. You can keep this acknowledgement as your proof, although you will get it in your email as well. The ITD REIN number gets generated. Thereafter, when you have to go to the site, the initial user ID and password which you will get, it is a temporary credentials. Once you enter, you will be prompted automatically. When you try to log in into the portal, you will be prompted automatically to change the temporary password. Once you do that, you again log in with your PAN and password. Once you enter, so now you have entered as a principal officer. Now one person can be principal officer for say 5 companies. So in that case, and in those 5 cases, there will be separate ITD REIN registration for you. So in this scenario, say for example, I have 5 such ITD REIN, and I want to select one of them, and my authorized person type is principal officer. In that case, I come to this window where I can do the compliance check for 206AB and 206CCA. So AB relates to the TDS part and CCA relates to the TCS part. So once I click on that, this compliance check window comes in, wherein you would see that there is a PAN search and there is a bulk search. So if you want to search for only one PAN, whether that vendor is non-compliant or not, you just enter PAN search and enter that person's PAN and the CAPTCHA and press the search button. Once you press the search button, you get the result like this. That is the name of the person. The full name does not come in. The PAN allotment date of the person, whether PAN and Aadhaar link is status is linked, and whether the person is a specified person or not. So if the answer is no, then he is a compliant person. I would rather say a green channel person in this case. In case of a bulk search, what happens is you have to, in case of bulk search, you have to download. When you press bulk search, you get this option as download CSV template. It is nothing but an Excel file. So once you download that, you get an Excel file like this, and you just put the PAN numbers for, say for example, you have 100 PAN for whom you want to check. You just paste the 100 PAN numbers here, save the file, and then press upload CSV. When you press upload CSV here, you will get this window, and then you choose the file from your desktop and then submit it. Once you submit that, you will see the window like this, and it will show like this, the upload date and all, and here you will see the status. It is downloaded, this is available. First, it will be coming as uploaded, and it will process for some time. Then it will come as available. When it is available, you can press and download. Once you have downloaded, it gets downloaded as well. After some day, this link gets expired and it will be showing as link expired. So once you download it, you will see a report like this. This report will again say PAN name, PAN allotment date, link, PAN Aadhaar link status, and specified person. So you would see there are 3 types of status coming up here. No means the green channel, as we discussed, a compliant person. Yes means a non-compliant person, that's a red channel person. So this is a person who will be suffering the higher rate of 5% under section 206AB. Now, dash means it's an invalid PAN. Invalid PAN means that person does not have a PAN maybe, and rather the rigors of 206 AA may strike in this case, and the 20% rate may apply in that case as well. So this is a very important aspect which needs to be checked. So once this is done, what the circular says that you need to do once at least at the beginning of the financial year. Once it is done, all the no which are here, which are green channel, no means a compliant person, green channel person, you need not check for that person. So if you have 1,000 vendors, so you check for this and say 990 people are no, maybe compliant people, then you remove those 990 people. You need not check for that for the entire financial year. You check those balance 10% whenever the next time you make a payment to that person. Once a person, the next time you find that there are only 8 people coming as yes and 2 people has become no, then you remove them from the list, becoming and remove them from this red channel to the green channel. So they are fine. So once anybody is out of the red channel, that person is considered as green for the full year, and you will keep on preparing like that. A word of caution that you also need to check. We actually practically found out that this not link, this PAN Aadhaar link status is not important as on today, but it will get important in the forthcoming months. But in one case we saw that it's coming as not linked, but the person, he himself has linked his Aadhaar to the PAN and can show a confirmation printout that their PAN is linked with the Aadhaar, but this report is showing as not linked. So, there are some maybe issues which is coming here. So thank God that this portion is not relevant as of now. But a word of caution to everyone that you must do a check or get your PAN also checked through the compliance check through some other person, so that you are very sure of what exactly report is being generated when your vendor or somebody else is checking for you. No, so what challenges this one brings in is that one needs to keep on checking that the compliance status of the vendor. That increases a compliance burden on the person. One has to proactively keep on checking whether TDS is happening or whether TCS under section 206C1 is happening or not, so that TDS will not apply. So all this checking and cross-checking, because one transaction from now on will have a TDS and a TCS component. So we have to, those confusions will come up. Secondly, you have to keep on tracking the declarations you get from people. Also, you may have to proactively ask your vendors not to deduct tax because you are collecting tax, or vice versa. So how do you control this situation? What is the solution for that? Solution is nothing, is surely towards control and automation. One needs to map the vendors with TDS and TCS applicability in the billing and the payment system, the ERP system. This mapping has to be done in larger organization. Without this mapping, it's going to be a massive issue. There has to be automated emails sent to vendors and customers, declarations. The ERP system has to be integrated in order to ensure that the responses which are coming is mapped. This report which we can see, it has to be mapped with the billing system or the payment system, the ERP system, in order to ensure that the matter is updated. So one needs to have their ERP system updated to cater to these needs and these requirements. Manually doing this, I won't solve the issue at all. Now, coming to it will be, when we're talking about TCS, we are coming into TCS statements as well. So what has this TCS thing has done? It has increased the compliance burden many folds. Now, if we take a step back, in the TDS era, when on supply of goods, there was no TCS also. Any large company, even if they're not into sale of scrap or sale of coal or anything, then there was no requirement of TCS statements to be filed at all. From the time 206C1H has come up, all supply of goods requires TCS, and hence all the companies are required to file the TCS statements. So this is a massive compliance burden which has come up. Now, with the advent of 194Q, what has happened is all these supplies would now require TDS and not a TCS. So these companies who were suddenly doing TCS would no longer be required to do TCS, and the TCS statements is required to be filed only when a person is required to collect TCS and pay TCS. So if I'm not required to collect and pay TCS, then I'm not required to submit a TCS return. So my compliance burden reduces considerably to this extent. And the 194Q TDS, whatever I am doing, I am supposed to do it along with my other TDS returns. Now, going forward, even if a TCS return was also being filed, what was happening is when I am doing a TCS under section 1H, if TDS applies, then TCS under section 1H does not apply. So what people were doing, if there was a TDS happening and TCS was not happening, such line items was not getting reported in the TDS statements at all, and is not required because tax is not collected at all because TDS has been done. Recently, there is an amendment in the rules wherein three more columns have been brought into the TCS statement. Although the utility has not come yet, you would see from the diagram here, the items up to which yellow marking is not there is the existing TCS statement. The yellow marked one is the one which has been proposed in the new one, or rather actually brought into the notification, that it mentions that in case I am not doing TCS because TDS has been deducted, then I have to mention that line item. It doesn't stop there. It also says give the challan number of the tax deduction which I have suffered and the date of TDS payment to the government. So think of a situation that I have sold an item and I have not done TCS because that item mandates a TDS under section 194Q. The buyer has done a TDS, that person has deposited the tax. I need to put the TDS challan number in which he has paid into my TCS return. Now that becomes a next to impossible sort of a thing, that how do I get that challan number within the time frame of filing the TCS return in this aspect. We all know that the TDS need to be deposited within 7 days of the next month, and my TCS return is supposed to be filed within 15th of the next quarter. Although we have a 7 days time to ask the person to give the TDS challan number, etc. But is it practically possible if I have thousands of vendors doing this? So that becomes a challenge as of now, to how to get this thing. But thankfully, the utility is not yet in place. Still now we have to fill up to here. This portion is not yet coming, so we can proceed in this. But this raises another question, that so a person who was not filing TCS statements till now because it was suffering TDS on its supply of goods, will it require to be filed again just to mention all these things? So in this thing, a view can be taken that per se TCS statement was not applicable for me because tax is not getting collected. So I would not per se file it, and hence these columns does not become relevant for me. But what about a person who also has a TCS obligation because that person sells scrap maybe? For that person, they will file a TCS statement, and once TCS statement becomes applicable, then these three columns again become applicable for that person, because this is a part of the prescribed format. And I believe that we cannot keep this thing blank. So in that scenario, that seller will put their scrap sale part first, and then they have to put the list of items on which TCS is not done because that person has suffered TDS. So that's going to be a massive compliance burden which will be coming into that person. And how will that be obtained is still everybody's question. So with that, I come to the end of this session. Definitely open to take questions either now or maybe at the end of the session. Thank you.
Any questions? Or shall we move on to the next session?
Sure.
I think we can proceed to the next session and we can take the question and answer session at the before the closing. So we have our next technical session on faceless assessment proceedings. I now request Mr. Bikash Chandra, Chartered Accountant from PwC, to take this session forward.
Thank you, Sharbani. First of all, am I visible and audible?
Your video is off, but you are audible.
Just give me a minute, maybe.
Yes, sir.
Okay. Good evening, everyone. And while we have heard so long about the deliberations on the new TDS provisions, the TCS provisions, as well as the rigors of the new law on reassessments, here we go into a procedural aspect on faceless assessment. And while continuing on the advice that, or the initial comments of Mr. Gupta, that this perhaps the faceless assessment proceedings which have now been introduced may be one of the single most important amendments or changes which have recently been introduced in the practice of income tax here in India. And just to understand the context as to how large or how all pervading this impact is, I would like all of you, or all my colleagues here, to just think about the days where we have at least at one point of time gone and visited the income tax department, and where we had waited outside the officer's chamber and gone in, given some details, taken requisitions for the balance, come back, gone there again, and repeated this particular process until the issue of the assessment order. And practically, even though it is a faceless assessment and it is being carried out in an electronic format through emails or through uploads in the e-filing portal, the essential or the essence of the event has remained the same, but it has just moved on into an online platform. This is a huge sea change in the sense you may be happy with some aspects while you may be unhappy with others. For example, in my case, I was extremely happy that I now don't have to wait outside the officer's chamber for a couple of hours before even meeting him. But the flip side is that what I can explain by writing or in a pen and paper, or by pointing out certain details on the paper, or showing the officer a particular amount of data or a particular amount of a particular specific data, that human interface has actually gone out of the case. There are pros, there are cons. The government, I'm sure, had very good intentions of introducing this particular thing. They definitely wanted to introduce more transparency. They wanted to eliminate an arbitrary human interface. They wanted a team-based assessment to happen, and they wanted optimum utilization of resources while introducing these schemes. Time will tell as to how successful we will be in the implementation of such procedures. But of course, the system has its pros and cons, and we will go through them and discuss more as we go along the slide. With this background, as you are already aware, the e-assessment scheme was introduced in 2019 initially. At that point of time, it was called e-assessment scheme 2019, and later it got rechristened as faceless assessment scheme by a notification in August 2020. And subsequently, we had the faceless assessment scheme that we now talk about, or the faceless assessment scheme as of now, being codified in section 144B, which was a part of the Taxation and Other Laws Amendment Act, which was passed in September 2020. Now, in this overall background, as a snapshot and as a bird's eye view, you can see that the impact of the earlier background or the historical movement of these legislations lead to a result where for the period up to 12th of August 2020, you had the manual process or the e-assessment scheme 2019 in force. Between 13th of August and 31st of March 2021, you had Faceless Assessment Scheme 2019 in force. And on and after 1st of April 2021, you had the Faceless Assessment Scheme in the manner as described in 144B, which I just spoke about. And it is this 144B and the Faceless Assessment Scheme under 144B which we will deliberate in details in the subsequent slides. Just to let you know that you are aware, as Deeparun had mentioned in an earlier slide, that there have been multiple extensions of due dates, multiple extensions of dates by which orders of assessment and reassessment may be passed. So where on 31st of March, there was any assessment that was pending, you will have to note that that will now automatically get transferred to the Faceless Assessment Scheme under 144B. So if whatever assessment was pending as on 31st of March will automatically get transferred under the new Faceless Assessment Scheme. And also to tell you that the modalities or the structure that was there under Faceless Assessment Scheme 2019 is substantially the same as the Faceless Assessment Scheme under 144B with a few minor changes here and there. Now, just to keep in mind that there are certain exceptions. Not all cases will be taken under a Faceless Assessment Scheme. There are certain exceptions where cases which are assigned to central charges, mostly relating to search and seizure, and international tax charges are still proposed to be done manually. There's also a carve out for the principal CCIT, National E-Assessment Center, to refer it back to the jurisdictional AO. But of course, for that, you need a prior approval of CBDT. You can also, I'd like to take your interest towards this particular internal communication of the Income Tax Department, wherein they have tried to list out certain cases which they would like to take up outside faceless assessment for various reasons. For example, one of the major reasons would be complicated cases such as restructuring, mergers and amalgamations, certain specific situations where taxpayers have deceased and you need the involvement of legal heirs. There are certain cases where there are no PAN and therefore no accounts in the e-filing portal, which makes it an impossibility to take it under faceless assessment schemes. There are cases where dependency cannot be created on the system because of technical glitches. So these are issues, these are the cases which the department itself is thinking that they may need to take out of the faceless assessment scheme. Of course, these are internal deliberations. We'll have to actually wait and see for the formal notifications, etc., to come out. So in a nutshell, everything after 1st of April 2021, faceless assessment. If it is not passed under the faceless assessment scheme, then it will be treated as non-est. There are certain cases which are intentionally left out in the law for a manual procedure, which we have just discussed. Now, what are exactly getting covered? As I've all told you, everything more or less. So returns filed under section 139, 142.1, 148.1, where simple notices under 143.2 have been issued. Those are covered. Cases where returns have not been filed in response to 142.1 or under 148.1 are also covered. So basically, all situations wherever you have filed a return or you have not filed a return, all situations are getting covered. If you see, they are covering orders which need to be passed under 143.3 and 144. So everything is getting covered over there. And because returns filed under 148 is also mentioned in the list to which faceless assessment applies, so it necessarily means that reassessment proceedings are also now conducted under in a broad visage of section 144B. Now, I would like to give you an overall idea of what this particular faceless assessment structure has been, the structure that has been put in place by the Revenue Department. So you can see right at the middle, National Faceless Assessment Center, or I'll refer to it as NFAC. NFAC is the facilitator, the person in the middle who is regulating the traffic, who is actually being the middleman and being the interface between all of the stakeholders. On one side being the taxpayer, on the other side being the various assessment units, verification units, technical units, review units, as well as the jurisdictional assessing officer right behind there. So any communication between the taxpayer and the income tax department is now necessarily through the NFAC. It is up to the NFAC now to refer the matters appropriately to an assessment unit. Where an assessment unit requires additional data, they will go back to the taxpayer through the NFAC. If they require additional information for verification, the NFAC will send it to verification units, or if they need technical support, they would send it to technical units. And of course, there is also a mechanism for review. This is basically the broad structure of the faceless assessment thing. And if you, this is what has been replaced and now put in place in place of the earlier physical assessment, where you needed to visit a particular officer and would have had to had a one-to-one conversation with him and had a broad level of discussions over there. Now, just what I had explained in the earlier slide, the entire bird's eye view, this is just a bullet pointers to show this is how the structure is there. NFAC, the process starts with NFAC serving you a 143.2 notice, requiring the assessee to file his return in an appropriate period of time. The NFAC then assigns the case to a specific assessment unit. The assessment unit may, as I said, request further information or require a conduct of inquiry or verification by the verification unit, or may require technical assistance on legal aspects maybe, or certain other aspects from a technical unit specially designated for that purpose. Now, on receipt of such requests from the assessment units, the NFAC would issue due notices or requisitions to the assessee for obtaining the information, and the assessee needs to comply within the date mentioned. Or else the NFAC may assign the case to a verification units or technical units to send the report as required. So that's the procedure which I had earlier told you, which basically is in the form of a specific thing. You will note that this is basically the same thing that we used to do earlier, but now we are doing everything through an electronic channel in electronic communication. The same thing, if you have failed to comply with the notice for further information of 142.1 or a direction under 142.2a, which is special audit, the NFAC shall serve a show cause notice under section 144. The assessee has to file his notice and reply unto the 144 notice, failing which your assessment may be completed to the best of the judgment of the assessing officer, of the assessment unit rather. I'm sorry for the. Now, this chart will actually tell you or present to you the process to be followed or the workflow to be followed, where there are variations to the draft order, or if I may say simply, where there are disallowances proposed to the assessment order. So upon a draft assessment order being formulated by one of the assessment units, the NFAC may, number one, issue a show cause notice. And if that is done, then the flow of the workflow would be as has been mentioned in the lower half of the chart. The notice would be issued, the assessee files a response, the NFAC forwards the response to the assessment unit. Based on that, the assessment unit may either accept it or may propose additional variations. If there are additional variations proposed, the NFAC would have to again issue a show cause notice. So bringing back the loop back to the second box there, issue show cause notice. In another circumstance where upon the reply furnished by the assessee, there are no additional variations, then the NFAC will proceed to forward a draft assessment order to the eligible assessee. Just a minute just to explain who is an eligible assessee, and we'll deal with in details later on and special provisions for eligible assessees. Eligible assessees are people for whom a transfer pricing adjustment has been suggested, or non-resident companies or non-resident foreign foreign companies or non-residents. So if SSC does not reply to a show cause notice, as we have already said, the draft assessment order would be forwarded in case of an eligible SSC, and in other cases, the final assessment order would be issued. Now, in certain circumstances, the NFAC, based on a draft assessment order and based on the risk management strategy, which is an automated tool which the department has developed, may decide to send the draft assessment order to a review unit. A review unit may either concur with the additions made in the draft assessment order. In that case, the NFAC would proceed to issue a show cause notice to the SSC, and the same procedure as I have just described earlier would be followed. Where the review unit suggests any modification based on its review, the NFAC would send the draft assessment order and the review unit comments to a different AU. This is important to note that they will send it to an assessment unit which is different from the original assessment unit. And based on that, the NFAC will either show cause notice or proceed to finalize the assessment as per the discussions we have done earlier. Now, in a happier situation where no variations are there in the draft assessment order or no additions are prescribed, obviously the simplest way is, or the most desirable way is, that the NFAC would finalize the assessment by forwarding a draft order to the eligible SSC or giving the final order to any other SSC. And even in this kind of a scenario, if the NFAC decides based on their own internal strategies and policies, they may send it to a review unit, and the procedure is very much almost the same that I had described, where a review unit would concur, the order would be finalized. If the review unit does not concur, then the views of another assessment unit would have to be taken, and based on that second view, the assessment order will be finalized. So these are the two circumstances where variations are proposed and where variations are not proposed. Now, even though I have been talking to you so long that this is an electronic procedure and all communications are through electronic means, there are provisions. There is a particular provision in section 144B, which specifically talks about the right of an SSC to ask for a personal hearing where he thinks that there is an order which is supposed to be prejudicial to him that gets passed. Now, the particular section does refer to it that prescribed circumstances. This, first of all, the personal hearing a request would have to be made. That request has to be approved by the Chief Commissioner of the Regional Faceless Assessment Center, meaning the Faceless Assessment Center which is in charge of the assessment at that particular point of time. The CCI2 has to concur, and it is mentioned in the Act that the board would lay down prescribed circumstances under which such personal hearing may be granted. However, the CBDT is yet to come up with a formal note or a formal circular mentioning what are the prescribed circumstances under which a personal hearing may be granted. However, if you go to the e-filing portal, and if we refer to the drop-down box where you need to request for a personal hearing, these are the points which they have mentioned as grounds for asking for a personal hearing. That the material submitted, whatever was submitted by the SSC, has not been considered in the draft order, or the matter requires explanation due to complexity of facts, inability to explain properly in writing, and oral evidence is felt more necessary, or any other reason. These are the 5 categories which you may select from the drop-down box as reasons to ask for a personal hearing. And I'm telling you that just because you have asked for a personal hearing, it is not necessary that you will always be granted a personal hearing. Based on the experience that I've had, or we have had with some of our clients, the personal hearing more often than not is not granted. And there is also no formal rejection note saying that this is the reason that I feel your case is not fit for a personal hearing. That kind of a has not been there. So The law over there is, the situation over here is pretty much arbitrary. Some people do give, some people do not give. Now let's come to a situation where, you know, a personal hearing has been granted to you. So if a personal hearing has been granted to you, you can go and represent it yourself, or you could appoint an authorized representative to represent on behalf of you, or both of you can go and represent, both meaning the SSE, a representative from the SSE side and his authorized representative. There is a particular link that comes mostly as a part of the notice itself. Nowadays it comes as a part of the notice itself, and the password to that will also come. Now there was a huge hue and cry in earlier cases where, you know, the passwords were not coming within time, or they were not even sent, links were not working. So all those of technical glitches and things were always there. So several hurdles and several roadblocks. First of all, you may not be granted a personal hearing even if you request for it. Even if you are granted, there could be an issue in technicalities where your link may not work, the password may not come, on the date of the hearing, the link may not be working. Those might kind of technical glitches may have come. The third point is that once you have a personal hearing, it's generally half an hour personal hearing that is fixed, and there is something which says that the standard operating procedure which has been, you know, circulated by the board or the department talks about that this half an hour personal hearing may be extended if it is so felt necessary. So you get half an hour to actually explain your case to the officer. We have had mixed experiences. In certain cases, the tax officer has understood the intricacies of the case, and in certain proposed disallowances have been removed. In other cases, we have found that it was a purely mechanical kind of an exercise where there was somebody who just heard through you, and there was no change in the draft assessment order based on your personal hearing. However, if you ask for a suggestion, or if there is a question coming up that whether I should then opt for a personal hearing or not, I'd still say that why not take a chance of convincing him over it, because there are cases where you know, see, sufficiently senior people have attended, and, you know, benefits have flown down and proposed disallowances have not occurred. So it's always worth taking the chance. Now, quickly, if I can go through some additional procedures for eligible assessees. As I've mentioned, eligible assessees are those for whom a variation is proposed by transfer pricing laws or transfer pricing officers, and eligible assessees are those who are non-residents or any foreign companies. So in this particular case, as you're aware that for non-residents or for these eligible assessees, the NFAC would first serve a draft assessment order and would request the assessee, and the assessee is supposed to either accept the variations within a specified period of time, or if no objections are filed, if no objections are received within the specified time, the NFAC may proceed to finalize the assessment. If the assessee files objections with the dispute resolution panel, then the NFAC can only finalize the assessment order after directions are received from the DRP. Pretty much the same that was there earlier. Appeal procedures, as we've I just kept a slide, although this is not the subject matter of today's discussion. Once you get an assessment order or a draft assessment order, eligible assessees have the option of going through the DRP route. If they choose not to go through the DRP route, then the normal appellate forums is always the other alternate route. Whereas for other assessees, obviously the normal challenge of going through CITPs and ITATs. Just wanted to mention here that even in case of appeals nowadays, you have a faceless appeal scheme where, you know, the appeals are conducted in a faceless manner, which we may discuss in some other forum. Certain important aspects that I needed to inform, or rather go through. There is these particular things attain very much importance because of the entire manner of serving everything electronically and doing the entire thing through an electronic manner. Registered email address. So the NFAC is supposed to deliver communication either to the registered email address, or it has to be delivered to the registered account of the particular SSC. What is a registered email address? So as per the section, a registered email address may include an email address that is available in the account registered in the designated portal. It could be an email address that was mentioned in the last income tax return. It could be the email address mentioned in the PAN database, the official website of MCA, or an email address made available to the income tax authority. Now, as you can understand that since the appropriate conduct or the appropriate reaction or reply to this to notices would depend upon timely receipt of these emails or these communications, it's very, very important that these email addresses are kept up to date. It may be a good idea to have 2 or 3 people marked as a part of the group. For example, in an organization, if it is if you have a group called direct tax litigation, or you have a group called assessment group, and you create an a special group where 5 or 6 concerned employees are made part of that centralized group, so that any communication from the department goes to that particular email address. So if multiple people receive the same email address, the chances of getting missed out is obviously less. That kind of a control procedure should be put in place. Now, what is a delivery of an electronic record? If registered email address is important, what is the delivery of an electronic record? It's important to note these things because earlier we had a system where we used to rely on the postal addresses, the stamps, and the inward registers as to see who delivered what and what was received on what date. Here, since everything has a digital footing, you'll have to see that when this particular notice electronic record is getting delivered. So electronic records gets delivered by placing an authenticated copy in the SSC's registered account e-filing portal, or sending an authenticated copy to the registered email address of the SSC. Or it could also mean uploading an authenticated copy on the SSC's mobile app. Now, this mobile app thing has not yet been formalized, but this is a proposal. This is there in the section, but nothing concrete has as yet come. I'm yet to come across any assessment order getting served through any mobile app, but maybe somewhere down the line, maybe we'll see that kind of a scenario as well. Authentication of an electronic record would have to be through a digital signature. For individuals, you also have the option of going through an electronic verification code to verify it, or you may use a digital signature as well. Now, some issues that we had actually identified based on our experiences and an overall analysis of the sections. First issue that would definitely be arising is there are multiple levels of reconciliations and data reconciliation, data points reconciliation, which the officers are now asking at. Various sets of data which may emerge from multiple levels and multiple departments of the government, which needs to be either tied up amongst themselves or with some other data emerging from the financial statements or the tax returns of the SSC himself. So that kind of a reconciliation becomes important and may become very difficult, particularly when you are dealing with voluminous data. Also, I'd also like to tell you that the faceless assessment scheme, it has been observed, they do not allow much time to reply. 10 to 15 days, hardly, never more than that. Gone are the days of a 30-day extension to the first notice. Those days are, I think, pretty much gone. Here they are only giving time of 7 to 10 days, and getting these reconciliations done within such a stringent time frame could be difficult, particularly if these reconciliation questions come up at the fag end of the time barring date. You could even be given a one or 2 day time to give a reconciliation. There is a question as to whether the NFAC or the regional faceless assessment center would give any cognizance to jurisdictional, high court or tribunal rulings. That is something that we have to see how the practices evolve and how the matters evolve. Obviously, as a matter of best practices, we do quote precedents in judicial precedents in favor of the SSC to defend our own cases. There is a doubt as to who will deal with set-aside assessments. This, as far as practice goes, I have seen that all assessments are now more or less dealt with by the NFAC. But where there is only a partial set-aside, where something needs to be decided only on one ground or two grounds, we could even see a scenario where the jurisdictional AO is doing it. This is something that we'll have to keep a lookout for. The next issue that I wanted to say is talk about is we had a section 144A. If you remember that, it was talking about the power of a joint commissioner to issue directions in certain cases. This was earlier. We used to use this, or we used to go to the joint commissioner for a direction when there was a particularly complicated case and where my views and the assessing officer's views were not eye to eye, and we would try and get a joint commissioner's view on that. The faceless assessment scheme does not have any scheme for referring to the joint commissioner, but you can also observe that from the earlier slides that I have shown you, the faceless assessment scheme has checks and balances to refer the matters to review units, to alternate assessment units if there are differences of opinions. So I think the intention of or the availability of a review level has already been enshrined or codified in the particular section itself, and therefore not setting aside a specific section for referring to joint commissioner, I think may not be affecting the rights of the SSC. Now, so far as the limitations of IT infrastructure, I think almost all of you have faced this issue, that the income tax website has restrictions on characters, it has restrictions on the number of attachments that you can upload. Therefore, when you have multiple questions and a huge amount of data as supporting documents, breaking it down into 5 MB pieces and uploading it multiple times is time consuming, and you may need to go through certain efforts to file everything. That is a challenge, but I guess the IT infrastructure will improve as we go on, and it might in future you might see where a situation where bulk data is permitted to be sent through emails directly, or maybe uploaded on a particular drive. Those kind of, we'll have to wait for all those nuances to get in place. Now, opportunity for a suo motu communication with the NFAC. If you remember, during assessment proceedings, if you have a situation where you need to state something to the assessing officer which is beyond the 142.1 notice, perhaps there was an additional claim which you had missed during return and you'd like to register that particular claim, or there could be an item which you would suo motu like to disallow and which was missed out during the return filing process. Now, these issues may not have been there in the 142.1 notice, and the e-filing portal does not, as of now, have any mandate where or any procedure by way you can suo motu give a reply to the NFAC without the NFAC coming to you with a notice. So obviously it is not an insurmountable challenge. I would have, the most obvious response to it would be to include my additional claims or my additional offerings to, or additional disallowances as a part of the response to the 142.1 which I file. So which makes it very important to actually carefully review the 142.1 response that I am filing, because in a physical scenario, I had the option of going and filing multiple letters before the officers quite easily. Here is a scenario that a subsequent notice may not come. So if I am responding to a notice, it has to be comprehensive to cover everything that has been mentioned in the notice and something else which I would like to state, for example, an additional claim. Now, so we've only had, if you can see, we've only had around 1.5 years of faceless assessment. There have been several and quite a few practical issues which have actually come up during assessments. The technical issues where notices have been served on wrong email IDs, or it has not even gone to email IDs. I've had clients coming up to me and saying that we did not receive any emails. and then the notice was actually found in the e-filing portal after several days. So notices not going to email ID or going to wrong email ID, going to email IDs where employees have already left is one of the biggest issues that is arising. Size limitations we've already discussed. Mismatches in assessment order and computation sheet is a typically rectification issue which we have seen coming up. Non-receipt of meeting password, I've discussed that elaborately when we were discussing personal hearings. This is something that has happened multiple times. The department is now trying to improve its system, and the password is now in certain cases being mentioned in the notice itself. So I think we are slowly trying to meet all the technical glitches. From the procedural issues, several uncomfortable situations have arisen where show cause notices have not been issued, draft assessment orders have not been issued, insufficient time to respond. As I told you, the NFAC is giving very short time to respond to the notices. The final orders are often passed without considering the objections to the draft order. 143.1 intimations, the total income as for 143 intimations are being taken without considering the rectification petitions filed. The final orders are issued before even the expiry of the time limit that was allowed to me in the show cause notice. And adjournment requests, as I have already told you, adjournment requests and virtual hearing requests, personal hearing requests are not always responded to and not always accepted. So these are some of the issues that we have faced so far during the assessment scheme, in addition to what we have already discussed in earlier slides. Though you have some email IDs for redressal of grievances, we have already in the past 12 to 14 months seen a spate of litigations, a spate of writ petitions on various issues. For example, Delhi and Bombay High Court have, struck off the assessment orders passed without issuing a draft order. Madras, Delhi and Bombay High Court have upheld writs where a show cause notice of draft assessment order was issued, but merely as a procedure, and those were not, duly addressed while passing the order. Then we have come across cases where, for example, this particular case in Renew Power, Delhi High Court, quite an interesting decision where the notice itself was mentioning a time limit of 20th April 23:59 that you are requested to file a reply before 23:59 on 20th of April 2021. The order, interestingly, was passed at 14:11. The SSC approached the High Court. The High Court said you cannot pass an order where even the statutory period has not expired. So this was thrown out. Then you had Delhi High Court in this particular case. It's quite an interesting thing also where, a opportunity for personal hearing was not granted. The Delhi High Court observed that the CBDT has not mentioned any procedures or circumstances under which personal hearing has to be granted, or what are the circumstances under which a personal hearing has to be granted. And therefore, it is only in the interest of justice that if the SSC thinks his case is eligible or deserves a personal hearing, then such opportunity should be given. And accordingly, the draft assessment order was set aside. So we've had a spate of litigations already on the faceless assessment scheme. And as you see, most of it is on the procedural aspect, that appropriate procedures was not followed. So I'd suggest that all of these need to be, taken care of, and appropriately digital records need to be maintained. Now, so far as way forward is concerned, way forward is concerned, rather these some suggestions. I think the best way possible preparation by a taxpayer needs to be prepared for certain things, because once the assessment starts, there is very little time to respond to notices and very little time to analyze and come to a position. So first of all, to stop the emails getting missed out, I typically suggest a centralized tax email ID being kept, mobile email ID, etc., to be updated. That's imperative, number one. Second is that I'd always say that you should be proactive in assessment preparations, in the sense that there could be situations where you should have mock assessment procedures and Supposing in a situation where you list down 15 most common questions asked based on the company's history and have that data prepared much before the assessment procedure starts. That could be an advanced preparation, a mock trial, a mock preparations, so that once the assessment procedure actually start, you really don't need to give that much of effort, for which you will in any case not get much time. Invest in technology, yes, that is required, because the kind of reconciliations and the kind of data points that they are asking you to match is seriously something that needs software support. You need, if you are asked to match a certain turnover as per maybe the GST return with something which is there in your financial returns, could be an issue. Customs records with your purchase records, you need serious good record keeping, and that could also need software support to give you the appropriate reconciliations. Diligent return preparations, appropriate reconciliation numbers, records need to be kept and retained. The time the concerned the persons who have filed the returns, there could be a gap between the persons who have filed it and the persons who finally go and represent the company in assessments. There could be a gap, and therefore the need for keeping everything well prepared. For submissions, self-explanatory replies to be as precise as possible and to the point, so that the questions are appropriately replied. Litigation history on the company should be there. Submissions should be duly divided into paras and references appropriately. Earlier we have to remember, earlier we had a leeway to actually go to the officer's room, open the particular page and show him that this is the thing that I want to show you. Here, since that is not possible, it's all the more imperative that the submission is self-explanatory and references are appropriately given, so that it's possible for the SSC to for the officer to understand that. So I'll stop here, and we'll be happy to take questions.
Any questions, please? You may ask to the speaker or write in the chat box. So the speaker will take up appropriately. Participants can unmute yourself and may ask the questions.
If there are any questions, kindly raise your hand and let us have any queries if you have.
We have one question from Shaunik Mukherjee. He has written in the chat box, kindly discuss applicability of TDS. Kindly discuss applicability of TDS on purchase of a normal software and B by a specific software.
Yeah, thank you. Thanks a lot for the question here. So first of all, one needs to see whether that software will be considered as a goods or not. And as we all know, there are a plethora of judgments which talk about whether a software is goods or not. There are cases from an indirect tax perspective that whether off-the-shelf software will be considered as goods. And in those scenarios, and these are very fact specific, that whether it will be considered goods or not, and considering the principle of the Supreme Court in the cases of software, wherein it has been considered as goods, these off-the-shelf software, then the obligation for 194 trickles in. That is number one. Number two, there is another aspect when we are talking about software which will come up is we all know that there is a provision. Generally, software, if it is not goods, it is TDS is generally applicable under the other section as royalty in 194J or something like that. So either if it is not goods, then 194J gets applied, which is a higher rate, and that supersedes 194Q. If it's goods, then it falls under the provisions of 194Q. Now, having said so, a question definitely arises in this case that when a distributor purchases a software and sells as is to another party, there is a circular which says that the provisions of 194J does not apply in that because the distributor had already deducted tax in the initial purchase. So whether that, when this transaction goes outside the ambit of the TDS, whether 194Q will apply in the subsequent sale or not is a debatable question which comes up. But still, first of all, we need to see whether it is in the nature of goods or not. And if it is not per se goods, then it should not apply as such. I believe that answered your question.
We have a question from Mr. Rahul Mukherjee. Will you please unmute yourself and ask the question? Mr. Rahul.
I can see it.
Yes, it's in the chat box also.
I can see in the chat box, and let me just read that out then.
Okay.
Okay,
so,
sir.
So if any particular invoice includes both material and service labor cost, then which section will be applicable? Whether 194Q is applicable in case of SEZ supply, deemed export, deemed import, and free replacement. Now, so when we are talking about material, service, labor, see, first of all, one needs to find out that whether what I'm paying for is goods or not. So it will be a bit fact specific whether it will tantamount to be goods or not, or whether the other provisions of TDS are coming in or not. In case 194C is applicable per se, then I will not apply 194Q. So that goes out of the question. So whenever two sections seems plausible in case of a payment, then we will have to apply the other section. 194Q will not apply in that scenario. But in case 194C is not applicable, and there are material which is getting sold and it is goods per se, then 194Q seems to come in. So it has now become, I would say, a all-pervasive thing that something or the other will be applicable in the instant case. And hence, if it is goods which is going in, there will be a 194Q applicable coming up. Now, when you're talking about in case of SEZ supply, which is a deemed export. Now, in case of deemed, see 194Q, it says that whenever a person purchases from a resident, then 194Q would apply. So there is no other exclusion given that in any other case it will apply or not. This import-export exclusion is coming under 206C H1C, where this debate comes up whether a deemed export or import will come into place or not. But that ambiguity is not there in 194Q when it does not talk about whether it's an import or export. It only deals with whether the seller is resident or not. If the seller is resident, then this applies to an extent. Now one needs to see whether the entity is exempt as a person if the entity is exempt as a person and not conditionally exempt, or any specific income is not exempt, then 194Q applies. But if that person is exempt as a person, then 194Q does not apply. I'll just go to the next one.
But,
Yeah.
Appeal, I think in the question, the first question of Rahul Mukherjee,
Yeah.
you read it, basically what his query is that there are two legs to the invoice. In the same invoice, suppose the goods are for 100 rupees and another 50 rupees of labor charges.
Right.
So what section should be applied? Very basic.
Yeah. Yes. So see, first of all, one needs to see that whether 194C applies to that or not. That is the first question which comes up. So even before we delve into 194Q, we have to see the applicability of 194C, and there we have circulars which indicates that in an invoice, whether 194C will apply or not, whether it's a combined invoice or not, whether they are segregated or two separate invoices which are coming in. So that is dealt in, I believe, Circular 786, where if it is in one invoice, then the entire invoice would be considered for 194C. But if it is two segregated, then the service portion will have 194C and the goods portion will not. In case the entire thing is chargeable to 194C, then there is no question of 194Q at all. But if a position is taken in 194C that only a part will be for 194C and the goods part goes away scot-free, then the goods portion will have a 194Q implication.
Okay, now it's
the third question, I think, is should I move on to the next one?
Yeah. Please.
Yeah. So I'll just ask maybe Bikash to take it.
I think the third question is relating to reassessment, so I will take it.
Yeah.
So I think there are a couple of questions there. The first one is saying what will happen to the reassessment notice received for the assessment year which is under appeal. So see, under the erstwhile provisions of 147, there is a specific proviso which said that if the assessing officer may assess or reassess such income other than the income which is involving matters which is the subject matter of an appeal. So there was a specific proviso which said that. So now under the procedure of the new reassessment thing, this thing is not there. So by thing, we can compare the old one. Somebody can say, because there is an explicit permission there, somebody may say that whether such explicit permission, if it is because it is removed, whether it is there in the new section, somebody may argue that this is removed, so it's not there. But I think there is an implicit right under the legislation that irrespective of whether something is an appeal or not, 147 should be there. So earlier there were some litigations, etc., which happened. To do away all those litigations, that particular provision was inserted. Now I think we are going back to the open position, and it needs to be seen how this arises in the course of section. But by implicit law of the law, even if something is an appeal, that year can be selected for 147. But we have to see if some particular issue is an appeal, and that is a ground of appeal in itself, whether how much the assessing officer has a right to disturb that particular item. So I think because of the omission of this particular provision in the new reassessment section, we have to see how this emerges in the course of time. But as of now, there is no explicit prohibition or there is an explicit permission also. So that is, I think, the first question. Next question is interesting. It says, if any notice under 148 is issued for 1516 on 19th of April 2021, valid after considering TOLA. So we have to see to check the notice under which law they have issued. So if you will go back to the old law and the new law. So the default is 4 years. If I count here, 17, 18, 19, 20. But as I said, anything till 31st March 20 or 21 has gotten extended by wide of TOLA. So department will say that this is within the extended timelines which has been given under TOLA. So anything issued under till June, that is in this case 19th of April, should be valid as far as time limit is concerned. But I repeat, we have to very carefully check whether the procedure which has been prescribed under the new reassessment procedure, that is whether 148A has been followed or not, whether assessing officer has those information with him or not, whether he has taken the necessary approvals under 151 or not, that needs to be checked on a fact specific basis. And that basis we have to see whether the notice is valid or not. If you ask me only timeline, then yes, TOLA has extended the timeline and this is okay. I think that's the answer.
Any other question? Rahul Mukherjee, does he have the question still? His hand is still being shown as raised. I'm just wondering if he wants to have any other query sorted out. Otherwise,
No, he has removed that.
oh, he has removed. Okay, okay, okay. I think, Sharbani, I think I will give the closing remarks because there are no
Okay.
other questions, looks like.
Okay, sir.
Okay. Very, very invigorating discussions today. I think a lot of learning for all of us on the emerging scenario which is emerging. And it's extremely, it's a very, very dynamic environment. There are so many other queries also which I think would arise as we go along in all the new areas. For example, in the reassessment side, I can see number of disputes coming on the treatment of information for the assessing officer. What is information? There have been some decisions on the subject earlier, but now the position is changed. And today, in the context of the new law, one will have to observe what the courts hold as information. For example, any unreliable accusations by a competitor, would it be treated as information? And it could result in harassment. I think all these things will happen. I'm not wanting to speculate too much, but it could be misused. That's my general feeling. And even if you have the provision for approval before the inquiry by the assessing officer, the worry is that it could be misused in certain quarters. And government, I think, will have to restrict the applicability of the term information to only very, very reliable, well-documented, well-researched, and well acceptable in a format, not mere hearsay or some press on some issue in the press, like something to do with competition, something to do with maybe a foreign currency dealing, or some transaction which one may have entered into. All these will now get explained as we go along. In the area of faceless assessment, I think it is a hugely procedural law, and the law is getting streamlined. So to that extent, there would be initial hiccups, but it should fall in place over a period of time. Currently, everyone is facing a host of problems with the new income tax portal, which is getting corrected as we are proceeding to the time-barred September month for filing of returns for individuals, and then the other returns will follow. And hopefully the current issues will get addressed. And to that extent, all submissions, assessments, appeals, etc., will get documented, recorded through the new portal as we go along. And it should really be cleaned up. TDS is going to be very, very challenging. I think of all the three presentations, I could make out that it is a hugely applied law, applicable to all units, to one and all, in every section of the society, to all types of business organizations. And it is going to be extremely tricky as to how it will get applied as we go along. For example, the simple question which that person, I think Mr. Rahul Mukherjee had raised, that if in one invoice we have two items, what section should it be taxed? Now it is a very obvious thing. And I agree, what Kapil had said was a very technical response. But the the problem is you got to get back into the law and see whether it will be treated as part of 194C, or again you got to take it as part of the new law and say it's 194Q which is applicable, or you raise separate invoices. Now, I feel the safest way is to just get separate invoices raised and finish off with the TDS. But it is a problematical area. These are some specimens of the issues which can crop up, and I wonder I think what we should do is that all income tax online systems should have a response mechanism where every party, every affected organization, every individual can pick up the phone and raise the questions and get the responses. I think we need that to happen as we go along. Maybe some sort of a Seva Kendra. For example, in Aikar, we had one earlier when we started the Seva Kendras for filing of returns and helping assessors, etc. So this sort of help desks are required, even through an online mechanism if possible, preferably through an online mechanism. Today's grievance redressal systems are there, but it is extremely centralized and it's really not as workable because the systems themselves have not got straightened enough and there are too many ambiguities. But after these things fall in line, I think we need a good voice response system, at least, if not a physical center in various Aikar bhavans to respond to the queries of the various parties who are affected. With these few words, I conclude the session.
Sir, we have one more question from Mr. Rahul Mukherjee. Can we take it?
Yeah, please, let him finish it off. Yeah. Let him raise the question.
Suppose 194Q is applicable in between buyer and seller, but in case such relationship reverse, which will the section applicable from the buyer side?
Yeah.
See, I'm not sure I understood the question perfectly, but what I understand is in case there is a 194Q applicable on one side, whether there will be from the other, whether there will be anything from the seller side or something. If Mr. Mukherjee can just let me know what exactly he wants to know. I just need some clarity on the question actually.
Mr. Mukherjee, will you please clarify the question? Mr. Rahul Mukherjee? Mr. Rahul Mukherjee?
I think he will. What he's
Yes, sir. Actually, we want to know if the seller and the buyer are the same party. This is my same question actually. If the seller and the buyer are the same party, then what should
seller and the buyer? So you are talking about one transaction. In one transaction, seller and buyer.
Two transactions maybe.
There are two transactions, Mr. Mukherjee.
Two transactions.
Okay, understood. Got it. So in transaction one, company A is the buyer and buying from company B. And in the second transaction, company B is buying from company A. Is that the correct understanding? Yeah. Okay. Very good. See, in this case, there are two transactions and two separate legs of 194Q. So in transaction one, where company A is the buyer from B, 194Q will apply on company A. They will deduct the tax while making the payment to the seller, that is company B. In the second transaction, when company B makes the payment, buys from company A, then company B will undertake the tax deduction while in the payment mode. So in the two transactions, two separate people will be doing 194Q being the buyer. Does that answer your question?
No adjustment possible.
No adjustment possible, right.
I think that's what the query was maybe.
I think it's resolved, yeah.
Okay. I think then we can conclude today's program. A big thank you to our friends from Pricewaterhouse for taking all the pains in taking out time for conducting this program. And I agree that it's a very, very complex subject, hugely debatable, and there will be issues as we go along. But still, on an overall basis, I think the presentations were self-revealing, and there's been a lot of learning for all of us. And again, we thank you. And we also thank all the participants who have attended today's program. And it was really a very, very, very difficult situation in today's world, because we would have loved to have hold the program in a physical mode and having a proper discussion at the end. But since it was not possible, we had to hold it online. Hopefully next time when we hold the program, it will be in physical mode. And with these few words, we conclude today's program. Thanks to everyone. Thank you, Sharpan.
Thank you, sir. Thank you, everyone, for joining
Thank you.
joining today. Thank you.